So how do you save for your first home? Well, you need to save at least $250 a week. In a year, you'll have $12,000. And in 3 years, you'll have $46,000 plus interest, which is enough money for your down payments on a $500,000 house. Well, you will have 17,500 for your down payments, another 17,500 or a little more for your closing costs, and you'll have 8,750 for your premium mortgage insurance. In total, you'll have $43,750,000, and you'll have an extra for some fees. The FHA loan is for first-time home buyers, or maybe you want to take a conventional loan, which you'll have to put down 20%. But on an FHA loan, you only need 3.5% down. If you have the score of 580, it needs to be the borrower's primary residence. You need to have a job and an income tax. They will definitely check your debt to income ratio, which is basically how much you make, how much debt do you have compared to the payment of mortgage that you'll have to make. And loans are usually accepted if they are within the 43% of total debts of your income. Well, it's pretty easy. If you save and you do this, you take these steps, you will absolutely be able to buy a house. Next slide.
All right, so I'm going to be talking about the different ways that we can save and different saving styles for buying a home. So one of the first ways that you can save is by setting goals. This includes finding out how much of the down payment is, which in most cases can be as low as 3%. However, requirements may vary by mortgage type and lender. There are down payment calculators on the internet to help determine an amount with the numbers you put in. Also, you want to figure out the closing cost. This can usually be around 2 to 5% of the loan amount. Another way that we can save for a home is by minimizing expenses. This includes any out-of-pocket expenses. So someone looking to buy for a house should compare car insurance rates, find out if you can bundle on cable internet, change your cell phone plan to a cheaper option. You can refinance your students' loans or auto loans to lower your monthly payments and cancel any of those subscriptions you really aren't using or you can live without for a period of time. Another way that we can save is by maximizing our savings. This includes setting up automatic transfers from saving accounts to from checking to saving accounts so money is out of reach for immediate spending. This means that you want to keep your money in high yield saving accounts, money market accounts, or CDs. This is maximized by getting the highest interest rate possible. People really don't recommend holding money in stocks due to the fact that they're risky and not 100% certain. Another way that we can save for a house is by saving your raises. This includes transferring your tax refund, raises, bonuses, and any other savings before you can spend the extra money. Other tips just include tighten your spending temporarily, like the gym membership, going out to eat, your clothing budget. Maybe you can start buying generic, cut your cable for a bit, and then definitely you want to hold off on retirement savings temporarily, skip that summer vacation, sell stuff in a garage sale, and etc. At the end of the day, do whatever you can to reduce your debt because having debt can make it more difficult to qualify for a mortgage when the time has come.
Okay, how to fix or maintain your credit score. Managing your spending is one of the most important since you always have to keep track of what you spend and where your money goes. It also gives you like a better insight on what needs to be prioritized and what not. Along with you must have an emergency fund for personal emergencies. And if you have a pet or an animal, that should be another separate account for just an emergency fund for both of you. And then do not rely on your credit card for any emergency spending. And it is better to use credit card for necessary use and always keep your credit utilization below 30%. Since if you go above 30%, that would hurt your credit score. Another thing is to pay attention to due dates. Never miss a payment. If for any emergency it does happen, you can contact your bank and you can work together, but keep in mind that a missed payment will stay on your report for about 7.5 years. So for those years, every single bank or any single lender will see that you have a missed payment, and that would cause one, it would hurt your credit score, and two, it would cause like distrust among you and the lender. So if you are forgetful or don't feel like making payments manually every month, you can just set an automatic payments for your any loans or for your credit cards as well. And always check your statement. A statement is a summary of all of the transactions in your account, and you should always check that. And you should be paying attention at whatever is on your statement to give you a higher boost of your credit score. And then for fixing your credit score is to always be aware of the APR and interest rates, which this goes for both, just how to maintain it and fix it. APRs and interest rates can be a tricky way that can hurt you a lot if you don't know how to really use it. And don't get too many credit cards, since once again, it's easy to get lost in the cycle of just getting another credit card, which this leads to paying credit cards with other credit cards. That's a risky thing to do, since at times you can do it to benefit, considering that you can get a lower interest rate on one or the other one to pay the current credit statement that you have. But it can be like a never ending cycle to just like you get into another credit card, and it's like you just jump from debt to debt. And it's always good to maintain a good debt to credit ratio in order to get the best deals and best interest rates for when buying a home. And also, lastly, it is important to correct any errors, whether that is personal information, fraudulent activity, or missing accounts that is on your statement, that you should bring up to your bank and report it. Now on to the next slide.
Today, I will be discussing interest rates on mortgage loans. Considering houses are very expensive purchases, many first-time homeowners will need to apply for a mortgage loan. When considering a loan, banks look at the client's creditworthiness, which is a combination of their credit score, income, savings, and other financial factors. Banks correspond their interest rates with those set by the Federal Reserve. There are various types of mortgage loans, including conventional, which is suggested to people with good credit scores, jumbo, which is for people looking to purchase more expensive homes, and government issued, which is for people with low credit scores who have little money for a down payment. The most popular loans are a fixed rate mortgage and an adjustable rate mortgage. The fixed rate mortgage is suitable for people who intend on living in the home long term. These people prefer a fixed monthly rate during the duration of the loan. The adjustable rate mortgage is better suited for people who aren't sure if they will be residing in the house long term. These people would have lower interest rates and monthly payments in the beginning, and possibly pay higher rates in the future if they decided to stay longer. Within the fixed rate mortgage, there is an option of either a 15 or 30-year loan. The 30-year loans typically charge higher interest and lower monthly payments, but overall, a 30-year loan will cost more money than a 15-year loan. Currently, good interest rates stand at 5% for a 15-year fixed mortgage and 6% for a 30-year fixed mortgage. However, as seen in the chart, average interest rates are higher than that today. For a New Jersey resident applying for a $300,000 loan with a 20% down payment and a credit score of 700 to 719, the average rate is 7% for a 30-year fixed, 5.9% for a 15-year fixed, and 6.9% for an adjustable rate mortgage. If anybody has any questions regarding how to buy your first home, please contact Professor Rocos to let us know, and we will get back to you. Thank you.